Okay, welcome everybody to today's trustee seminar. My name's Tim Miller. I'm Head of Technical Services at Cavendish Superannuation. I'd like to welcome you all here today. I always enjoy speaking to the Adelaide crowd. As you know from our last seminar at the Wine Centre, I spoke to about 350 trustees, and it was a wonderful day here and there. And again here today, it's our biggest number around the country. So it just shows how much the trustees in Adelaide care, and I think a lot of that's probably got something to do with the location and the fact that Cavendish are here, and I know many of you have walked in today and seen Kevin and myself standing in the foyer, and Kevin and I have been standing in the foyer now at Cavendish for about 13 years, so it's good to see a lot of familiar faces. Today's seminar is predominantly about some information that the Tax Office have been releasing throughout this last 12 months, particularly around the pensions, and there's been some changes in the way that the ATO have interpreted a few things. So today we're going to look at those issues and how they can affect you, and really just the steps you need to take to make sure they don't affect you. So we'll talk through that, and please, as I said, if you've got any questions, ask those questions as we go along. So we're going to look at why we're here, the Tax Office reasons. We're going to look at a few of the issues raised by the Tax Office, so when a pension commences, when a pension ceases, and then after that, talk about a little bit more to do with some other announcements by the ATO. So the first thing is, why are we here? What's the point of today's seminar? Well, historically, we as administrators and yourselves as trustees ask a couple of questions to the Tax Office, a couple of questions that are fairly important because it all affects the tax status not only of yourself but of the superannuation fund. And the first question is, does the fund have a liability to pay a pension when a member dies? So effectively, we have a liability to pay a pension. When a member dies, what is the requirement of the super fund beyond that point? And that extends to the next issue, the second part of the question, which really is when somebody dies, does the fund still retain its exempt pension income deduction? Okay, and that's one of those critical issues, because what we know about superannuation is that when we hit retirement age and we start to take a pension, we know that the fund is no longer taxed. Okay, our income is no longer taxed, but also the fund is no longer taxed, and that's a huge issue. And what the Tax Office have done is they've released this ruling which have answered these questions to say, well, there are points in time, there are events that occur that will mean that your super fund is taxed again, and you need to take the appropriate steps if you don't want to pay that tax. And that's where we can help. I mean, we can't provide financial advice, and I'll make that point a couple of times throughout this presentation, but we can give you guidance on the information that the Tax Office provides to us, and we feel that that's an important part of our role. So July this year, the Tax Office released a draft ruling, and that ruling is when an income stream commences and when it ceases. Okay, now I'm going to use the term pension. The Tax Office refer to these things as income streams. In the superannuation environment, we refer to them as pensions. So when we're talking about pensions, we're talking about a superannuation income stream. So that ruling came out. It's in draft format. Okay, so we still don't have a final ruling. Normally, from draft to final takes anywhere between 3 to 6 months. This ruling's been in the pipelines for a couple of years, so I would expect that we hopefully see something final from the Tax Office early in the new year. So it's draft. So we take the information from the ruling and we try to adopt it and bring it into our normal processes to make life a lot easier once the ruling is finally adopted. This is one of the kickers of this ruling. It's effective from the 1st of July 2007. Okay? So when I start to talk to you about not meeting your minimums and maybe having an underpayment for a year, what this ruling is effectively saying is if somebody has gone back and not met their minimum in a year prior to now, then potentially the Tax Office could come and say, well, you're not entitled to a tax deduction for that period, and the fund has to pay tax on the income earned. Now, the industry is fairly strong on this date. You know, why introduce something that's 4 years old now? So we're hoping that from a final ruling point of view, that's something that is taken out and removed. Potentially a 1 July 2011 date is far more appropriate, we consider. However, in saying that, the likelihood of the Tax Office performing audits on prior year funds based purely on pension shortfalls is fairly minimal, but if there are other compliance issues within your fund, that's where the ATO may uncover something. So it's just something to be aware of. So what's the greatest risk? What are our risks as trustees of a self-managed superannuation fund? Well, the biggest risk is we lose our exempt pension income deduction. Okay, so what that really means is we normally operate in a 15% tax environment. Okay, from a self-managed super fund, we operate in a 15% tax environment. Once we start paying an income stream, a pension from the fund, then the income of the fund gets a deduction that brings that 15% tax down to zero. So the worst case scenario is we lose that 15% deduction and have to pay tax. All right, so that's as bad as it's going to be, but we don't want that because we're in our retirement phase. We've planned for this to pay no more tax, so that's obviously our goal, is to stop paying tax. The other one is the death benefit side of things, and this is not a new element. It's something that has now been brought out in the open, but administratively this has always been something that Cavendish have been aware of and have discussed with trustees, and that is that when you die, depending on who the benefit is payable to, there's potentially a capital gains tax liability, but we will discuss that in far more length later on in the presentation. So when does a pension commence? Look, we'll work through this relatively quickly because this is a fairly simple process for us. Basically, because this ruling is a tax ruling, it's not specific to self-managed super, so it has to go through the whole process. When you apply to your superannuation fund and they acknowledge that commencement date, that is when a pension commences. For a self-managed fund, it's a really straightforward sort of process. Your pension starts when you tell us to start it, okay? Or more to the point, it starts when you tell yourself that you want to start a pension. And that's, of course, one of the great anomalies of self-managed super, is that you meet with yourself a lot and you make a lot of decisions on your own, and then you report back to yourself about those decisions. So from a conceptual point of view, when you say you want to start a pension is when that pension starts. But the good thing about working with us as administrators is that we can talk about these issues and we can say, okay, well, we've got more money coming into the fund. We won't say that, you'll say we've got more money coming into the fund. When is the ideal time to start a pension? And that's when we can provide some assistance. Because once you've started that pension, you can't add more money. Okay, so you cannot roll more money into that pension, that existing pension. You can't make any contributions into that pension. So again, this whole concept of we've got more money to add may lead to multiple pensions being paid. Are multiple pensions such a bad thing? I'd suggest not. Okay, multiple pensions gives you the ability to do multiple estate planning issues, or have multiple estate planning opportunities for yourselves and from the tax, particularly for non-dependents. So if you've got adult children, using multiple pensions can help you gain better tax advantages, particularly for adult children who would otherwise pay tax. Okay, so the concept of having multiple pensions, the concept of not being able to add money to a pension is not necessarily a bad thing. Okay, the ability to stop and start whenever you choose having a self-managed super fund is not a bad thing. It's something that you have as a benefit over every other style of superannuation fund. And that's a huge advantage, one of the many advantages I see for self-managed super funds. Again, I did say I'd highlight this. A pension is a product, a self-managed super fund is a product, so we can't tell you that you should start a pension. Okay, that's something that you either need to make that decision on your own or seek professional advice on. But once you've made that decision, we can help you with the tax side of things. So administratively, the structure of the pension is something that Cavendish can help you with, and we certainly have the expertise of the people that have been doing retirement incomes for many years. So that's something that don't be afraid to ask the question. There's no such thing as a stupid question in superannuation. If anyone's seen the legislation, it's not small, and the government seem to change it on average probably every 6 months, so it keeps me certainly busy, but also the rest of our technical team at Cavendish. And when we talk about multiple pensions, the key is that when we start a pension, our tax-free and our taxable components are fixed. Okay, so as we go along in accumulation, we might have money coming in, we might make losses, we might make gains, and our tax-free and taxable as a percentage change. But once we start paying a pension, those numbers are fixed. And importantly, they are fixed right up until a death benefit is paid. Okay, so when we talk about death benefits and we talk about a pension ceasing because of death, what you've got to understand is that the tax-free and taxable components of those pensions don't change just because a member dies. So if you have a 100% tax-free pension and a member passes away and the tax office tell us that that pension has then ceased, when that benefit is paid out, it will still be paid out 100% tax-free. And that's why this concept of multiple income streams, multiple pensions, can be beneficial in a self-managed superannuation fund. So just to show you an example of that, we've got Jack, who's 60, 450,000 in taxable. So predominantly had employer contributions, maybe some self-employed contributions along the way. Wants to contribute a further 450 to the super fund, so has come into some money later on in working life, wants to contribute that to the superannuation fund. Now in Jack's circumstances, he wants to actually have a process where he can leave some money to his wife, but also some money to the adult children. So he wants to establish two pensions. So the best way for him to do that is to start his first pension with the 100% taxable component. So he sets that up, makes the contribution. So he's now adding $450,000 to an empty accumulation account, because that accumulation account has been transferred to a pension, and then starts a second pension. And that second pension is 100% tax-free. Okay, if Jack makes that contribution before starting the pension, then his benefits will forever be merged. Okay, but in this instance, he can split them by starting the pension, getting the timing right, so that he has the tax-free and the taxable. So that when he leaves the money, he leaves it as a reversionary pension to his wife, the taxable pension. She receives that tax-free as an income because Jack was over 60. The other 450, whatever the value is when he dies, goes 100% tax-free to the children. Okay, so it does create a tax benefit there. Now, with all of these issues, it's about your personal circumstances. Okay, so multiple pensions aren't necessary for everybody. If there are no adult children, okay, if there's no spouse, then you don't need to be setting up multiple pensions just for the sake of receiving multiple pension. It's about identifying your personal circumstances and seeing what is best for your situation. So when a pension commences is a fairly simple process. When you tell us, and then if you've got more money to add, it's when you tell us again, and we can always work together and in line with your financial advisors to work out the most appropriate time. When a pension ceases is a concept that the tax office have introduced because of this exempt pension income deduction. So what the tax office have said is, here is the situations that we will tell you that your pension no longer exists. And when your pension no longer exists, your fund becomes liable for tax again. Okay? Now that's because the tax office have two roles in superannuation, two roles in self-managed super. They are the compliance regulator for us. So they tell us when we're complying. We have to report all the issues to make sure that the fund is operated in accordance with the law, but they're also still the tax collector. Okay? Their primary role in life is to collect tax. So of course, if they can find an opportunity to collect tax, they will, and if that is on death, or if that is on stopping of a pension, then to them, the circumstances are somewhat irrelevant. It's what does the law say? So they need to interpret the law, and this is how they've interpreted it. They've basically said there are 4 situations when a pension will cease. So we'll run through those 4, a couple in more depth than the others. But basically, if you run out of money, well, that's a bit of a no-brainer. Okay, if you've got no money, your pension has ceased. I think we could probably all accept that. If the pension is fully commuted, now commutation is when you stop a pension. We will spend a little bit of time talking about that because commutations can be done for a number of reasons. It might be done because you want to add more money into the super fund, or there might be some other reasons. So we'll spend a bit of time on that. If a member dies and there is no automatic reversion, okay, so this is probably the most critical of the death benefit scenarios and reversionary pensions. If there's no automatic reversionary pension, then the liability to pay that pension ceases. We'll go into that in far more detail. And if a fund fails to satisfy the pension requirements. So this is the new one, and this is the one that has probably caught the industry a little bit off guard, and it's the one that we think has the potential for creating most problems for trustees. So we want to be on the front foot and say, well, let's find out how we make sure this doesn't happen. Okay, basically that's saying if you don't pay your minimum, you don't have a pension, and that's pretty critical in all of the planning that we do. So let's go through each of those. As I said, we don't need to spend a lot of time on the first one. When you have no money left, you have no pension. That's a pretty obvious situation. Basically, the ATO have said you can't add, the law says as well, you can't add to an existing pension. So once all of your money, all the income that can be distributed to your account, once all that has been distributed and you run out of money, then that pension ceases. So we're all pretty accepting of that situation. Any more money that you could potentially put into the fund would go into a new pension starting up. So that's simple. Commutations, okay, stopping a pension. Now this is a far more relevant situation because gone are the days where people just set up one pension at age 65 and have that pension paid continually. We now have transition to retirement pensions, so people are starting pensions as early as 55. People can make contributions up until age 75 if they're continuing to work. So mathematically, I've never seen this and kind of hope I don't ever have to see it, but theoretically, if you're contributing every one of those years from 55 to 75, you've got the potential of having 20 pensions. You've got the potential of stopping and starting your pension 20 times. Now, of course, as I say, administratively, no one really wants to be going down that path, but it's something that could occur. So commutations are there for a number of reasons, and what we need to do is identify why are we commuting a pension, or do we need to commute a pension, right? And then what are the tax impacts of it? Because if we commute a pension and take that money out, it's then a lump sum. So it's in a different tax environment to a pension. Now, this is one of those situations that for a lot of retirees is somewhat irrelevant because, as we know, once we're over 60, we don't pay any tax on a lump sum or a pension withdrawal. But again, the impact is more so on the fund. So it's on us as a trustee, not as a member, and that's what we need to take into consideration. So why do we commute pensions? What are the main reasons why people commute pensions? The first one is they want to roll back to accumulation. Okay, gone are the days where we have to take a pension age 65. Okay, we can leave our money in accumulation forever and a day. The fund will pay tax, yes, but we don't need to start a pension with it. So generally this is a capital preservation issue, one that you see a little bit more of when the markets are fluctuating a lot. So the market's down, a lot of people say, I want to protect my capital, so I'm going to stop the pension and leave my money in accumulation so I don't have to draw down any benefits. So yes, you lose your tax exemption status when you commute your pension to go back to accumulation. That's not a big issue because you know that you're making that decision to commute the pension at that point in time. Commencing a new pension. So again, this is probably the more relevant one where we're adding more contributions in transition to retirement. People stop their pension and they stop their pension with the idea of starting a new pension. So we're going to investigate that. I'm going to look at the concept of starting a new pension with everything or just starting an additional pension to what you've already got, because that can catch you out, and if you're not aware of your responsibilities, you can find yourself with a shortfall, and as we talk about in a moment, shortfalls are probably the real nasty moving forward. And then the other reason that we look at commuting pensions is because we're winding up the fund, or we wish to transfer to another fund. And this one here is an area, and whilst it might be on one of the slides later, it probably is the appropriate time to talk about it. A lot of people, or most self-managed super funds, 80% of self-managed super funds are two-member funds, okay? Husband, wife. That's the traditional self-managed super fund. There are different versions of it, but that is our primary self-managed fund that we see. In that 80% of self-managed super funds, you then get the next situation, and that is that there is a dominant member and a dominant trustee, okay? And that person was a person that instigated the super fund, makes a lot of the decisions of the fund, and then gets the other person to sign things on an annual basis. We've probably all at some point in time had a little bit of that going on with our self-managed superannuation funds, but it seems to be the way of the world, and hopefully through the education campaign and that we can make all trustees and members equal. But the problem with that is when that dominant trustee passes away, the second trustee, the second member, often doesn't. It's overwhelming. The responsibilities of being trustee become overwhelming, so they say, I just want to get out of here. I want to be out of the superannuation fund. That's fine, but you've got to understand the consequences of that and the potential tax liability associated with transferring out of the self-managed fund into another fund. Again, there's always a solution to these issues, and we can talk about those solutions. So what are the ramifications of the commutation? Well, as I said, we lose our tax exemption status. So that's a fairly big issue for a lot of us. Because we just assume that our pension will always be tax-free and that the fund will always be tax-free, a loss of that status means, hang on, I'm not getting all of my imputation credits back, or why am I paying money to the tax office now? I've paid all the tax. I've paid it all up prior to retirement. I don't want to pay any more tax now. So that's an issue, but then the other side of it is the capital gains tax. I often say, and I probably said it in last year's seminar when we focused on the death of a member scenario, I said we don't have death tax in Australia. They just hit it and they called it capital gains tax because that's where we can get caught out, is not understanding the capital gains tax ramifications of selling down assets at a certain point of time. And on the death of a member, it's one, but commuting a pension is another. That's one of those areas that we need to be aware of. If we commute a pension and we start a new pension, we have to recalculate those tax-free and taxable components. So everything that we talked about before, fixing your tax-free and taxable up until the date of death, if you stop your pension and add more money to it, then you are changing those percentages. So that's something to be aware of. If you've got 100% taxable money and you make a taxable contribution, sure, stop one, add, start another, because it has no effect. But if you have a 100% tax-free pension and you stop it and you add employer contributions or a self-employed contribution, you're going to start to reduce the tax-free nature of that pension. So then there are ramifications on the death of the member. So these are things that we need to consider. Again, if we take Jack's situation, if Jack had one pension and he stopped it, he commuted that pension to add that $450,000, he wouldn't have 100% taxable and 100% tax-free. He'd have one pension that was 50-50. Then when he pays the death benefit out, the adult children will have a 16.5% tax liability on that lump sum benefit, because we can't take a pension as an adult child. That was one of the other things introduced. And 1 July 2007 is an important date for this ruling, but that was a date, excuse me, for all of us where they rewrote the superannuation law, or they transferred it from one piece of legislation from a tax point of view to another. But they also made a few little changes along the way, and one of those changes was removing the ability to revert a pension to adult children. Simple decision to make. If we're going to tell you that your pensions are tax-free now, we don't want you to be able to revert them to adult children and them then receive a tax-free income, because the tax office are losing revenue. Okay, so the ability to revert a pension to an adult children ceased from 1 July 2007. Yes, there are limited circumstances, but for the majority of us, we don't fit into that category. So again, that's just to go through that process of Jack and taking the amount of money out. From a commutation, again, you really need to look at what the circumstances are, what you're trying to achieve out of it. If the purpose is to commence a new pension, what you've got to take into consideration is that you have minimum requirements. So if you stop your existing pension, you have a pro rata requirement from the 1st of July of the year up to the day that you stop that pension. You then have a pro rata requirement from the day you start that new pension to the end of the financial year. Okay? Pension starts on the 1st of June or after, so between 1 June and 30 June, there's no requirement to take that minimum, but it can have an effect on yourself from a drawdown point of view, and it comes back again to that capital preservation issue. And that's where you need to look and determine whether multiple pensions are a better option. I've got an example here. This is based on a real case that we had. From a circumstances point of view, it wasn't a huge issue because the trustees wanted the income, but just to show you what can occur. So you've got a client who is 64 years of age, $1 million in their pension. Their annual requirement for getting government reductions for the last couple of years is $40,000. Electing to take that pension annually, and the client takes it in the first half of the year. Now, a lot of the times when we take our pensions annually, we take it towards the end of the year. But in this circumstance, the client drew it earlier in the year. They then turned 65 in January. So prior to turning 65, they used the contribution rules and made a further $450,000 contribution to their superannuation fund. And they asked for that to be added to their existing pension. Okay, so they stopped their first pension and started a new pension. So they've combined, and it's basically, again, numbers aside, started a new pension for $1.45 million in January. So they had a pro rata requirement from July to January, and they had a new pro rata requirement from January to June. The issue is is that they'd already taken a full year's worth of pension prior to that commutation. which can only be allocated to that very first pension. So in this situation, they had a new pro rata amount of $29,000. Had this client started multiple pensions, they would have only had to have taken $9,000. So 9,000 plus the original 40 gives us 49. Had they have taken their pro rata minimum rather than their entire minimum up front, then they would have taken 20,000 there and then the 29,000 on the 1.45. Now, what does that mean? Well, it means that from a capital preservation point of view, this client has taken $20,000 more than they needed to for the year. As I said, there was a level of want with this client, so they wanted that additional money. But conceptually, you can draw down more than you have to just by not looking through what all the requirements are from a pension point of view and a commutation, starting one pension versus multiple pensions. Okay, so these are the things that you need to look at, and we can help you out with those numbers. If you're going to make a contribution and you want to start, we can say, okay, well, this would be roughly what your pro rata is. This is what you've taken. Here are some rough numbers for you. But what you've got to also understand is if you're on a monthly payment, as a lot of pensions are, then this sort of example is not really going to affect you because you'll probably take pretty close to your pro rata requirement by the time of commutation anyhow. So again, it really has an impact more so on those annual drawers than on regular pension payers. So it's one thing to be wary of. If you're winding up the fund, now this is an area that does concern me because it's never really addressed within the industry. If you're winding up your self-managed super fund and you want to move to another superannuation provider, okay, not so much if you're taking lump sums out, but if you're wanting to move to another provider, a lot of people say, well, I just want to transfer the assets. Right? I want to take the assets that I've got and I want to transfer them to my new superannuation fund. That's okay. However, your pension stops the day before you sell those assets, okay? Because you can't roll over a pension. You have to stop a pension, put it back to accumulation, and then transfer the balance to your new fund. So if you do that with assets, if the transfer is assets, then you've stopped your pension. You've then crystallised a capital gains tax event after stopping that pension and transferred those assets. So you have realised the capital gain. Now, we might be talking about 10%, but I think we all agree that 0 is still a better rate than 10 when it comes to the sell down of assets. So this concept of I want to retain these assets, given that the majority of those assets are listed securities, it may be easier to sell them down, then stop the pension, and then roll over the cash and get back into the market at that point in time. But again, that's something that you need to look at the appropriate advice of and the tax position. What's the cost of buying all these assets versus the tax cost associated with selling them after the pension has ceased? So that's one of the areas that people need to be aware of, okay? You've got the ability to take lump sums from your pension, okay? Other than transition to retirement, you've got the ability to take lump sums. So if you are not winding up to roll over, if you're winding up for the sake of wanting to close the fund, then just keep the pension running. Make the pension the last thing you stop, okay? Take the lump sums down. Take some of the assets as a lump sum from that pension. Do whatever you can to avoid the tax situation. And again, we can provide some guidance on that tax situation. Partial commutations. So we have a pension, we want to take a lump sum. They don't result in the pension ceasing. Okay, so if you take money out of your pension in the form of a lump sum, it has no detrimental effect on the pension from a tax point of view. To the contrary, it actually has a benefit where now that is counted towards your minimum pension. Okay, so if you take a lump sum out of your pension, it's only a partial amount, then that amount will count towards your minimum pension requirement. Prior to 1 July 2007, again, a fairly critical date, you had to take the minimum as well as what you took as a lump sum. Now it can all be incorporated. Doesn't work for transition to retirement pensions because generally that's preserved benefits and you can't take lump sums from preserved benefits. But it is beneficial, and the tax office in the ruling confirmed this. Okay, so it's been questionable for the last couple of years whether you can do it. Tax office confirmed it. So you cannot take a pension payment in specie. What that means is you cannot transfer shares to yourself and count that as a pension payment. You can call it a lump sum and it counts towards your minimum, but just can't call it a pension payment. Again, these are all the little anomalies within the law, which for you doesn't really mean much because you're just getting the benefit out. Okay, but from a practical sense and from a reporting sense to the ATO, we have to make sure we identify things correctly. So again, this strategy works very well for people between age 55 and 60 because there can be some tax savings on taking a lump sum rather than taking a pension. Again, beyond 60, much difference, not really, because all of our income is tax-free. But it can have a Centrelink impact. So again, if you're a Centrelink client, taking lump sums can be more beneficial than taking pensions, which will count towards the income test for social security purposes. So commutations, that's one of the issues. Death is, of course, the next issue. And the tax office position here isn't really a new position. Okay, I want to say that up front. The tax office haven't changed their position on death. They've just made it clearer. Okay, what the ATO did previously was said, here's our position for a single member fund. A single member fund with no beneficiaries. Their pension liability will cease when the member dies. Well, that's a fairly obvious statement. If there's no one else to receive the benefit, by the tax office saying the pension ceases, we all accept that. We assumed that what they really were saying was, if there was no continuing pension, then the liability would cease. So this is where this concept of reversionary pensions becomes interesting and very topical for us. And what the ATO are basically saying in this statement, and this is the statement directly from the ruling, is if on the death of a pension member, if there is no automatic reversion in place from the date of death, then the fund's liability to pay a pension ceases. Now, they make that sound worse than it really is. Okay, because what they're really saying is if there's no ability, or that pension stops the day you die if there's no automatic reversion. Fair enough, we can accept that comment. What they don't go on to say is there's so many other options out there available to you to make sure that the fund retains its exempt pension income status. And that's some of the stuff that I'm going to talk to you about in the next few minutes. So it's not a panic issue. It's just one of those things to realise that particular pension ceases the day the member dies. Okay, now the key to that is, and we get this question a lot, well, what's an automatic reversion pension? Because I set my pension up and we've talked about it, that when I die, my wife will get it or my husband will get it. Is that an automatic reversionary pension? Well, what we need to do is we need to go back to the minutes, the original pension documentation, and in the majority of cases, it's not reversionary, because on the minute it says, is this pension reversionary? And people say no. And why do we say no? Well, because again, before the 1st of July 2007, we operated in a different tax regime. Okay, we had a deductible amount. A lot of people in this room would remember their deductible amounts. That was the tax deduction they got to offset their pension income every year. Why were our pensions not reversionary? Well, they were not reversionary because our deductible amount was calculated based on our longest life expectancy. Our longest life expectancy. So if we set up our pension as reversionary and we had a younger spouse, they generally had a longer life expectancy, which gave us a smaller tax deduction. So what we generally did, and historically if we go back through our old allocated pensions, we will see that the majority of them are set up with some form of system that said, this pension is not reversionary, however, on the death of the member, we are likely to revert it to our spouse. And that was to get the best tax benefit for ourselves personally at the time. So the majority of pensions do not automatically revert. Okay? That's a fairly simple statement that I can make to you. The majority of the pensions that we have don't automatically revert. However, that's not all doom and gloom, because automatically is just a straight through transfer process. For us to be able to continue paying a pension, we just need to know what your intention is. If you want your pension to continue to your spouse, then just say so, and we'll continue that. It will be a new pension for your spouse, but the fund will still retain the exempt pension income deduction. So it is not as big an issue as the tax office and potentially the industry make it out to be. And particularly for a self-managed super fund. It's far easier for self-managed super funds because, again, it comes back to that whole concept of you meeting with yourself regularly to talk about what you want to do. So as a couple, if you meet and say, okay, when one of us passes away, what do we want to do? Well, we want to keep receiving the income. We want to receive a pension beyond this point. Well, there's your trustee meeting. And that trustee meeting has just confirmed what the trustee's intent is, and that is to pay a pension to your spouse when you die. Okay? Because what we know, after all these years administering funds, is what we know is when a member passes away, the activity of the fund ceases. Okay? There is very little activity within a self-managed super fund for the months post a member's death. So there's not a lot of selling down of assets. There might be some income that is received, but generally the activity ceases, and then when people are ready to, they come back and say, okay, this is what we want to do. So if you've got monthly pensions in place and those payments have continued to come on, that makes life easy, because we can say, okay, well, let's have that pension commence from the date of death, and those payments to the spouse, their new pension payments, will do a new calculation for you. Okay, but it is a critical area, this death situation, and I've probably covered off a lot of these next few slides in that discussion. So there is still an issue, obviously, for single member funds, and more importantly, no, not more importantly, equally as important for two member funds when the first member has died. Okay, because superannuation is very simple from a death benefit point of view when member one passes away, because we transfer our benefits to member two. Okay, but when member two passes away, that's when adult children and estates start to get involved, and we need to know the tax ramifications there. Okay, because we can't automatically revert a pension at that point in time, so that's when we need to look at the capital gains tax of the situation to determine, are we better off selling down our assets while we pay pension? Right? Are we better off starting to slowly liquidate our investments or reset our capital gains tax position? And only your own investment strategy, maybe your broker or your advisor can help you with that, because you may not be in a situation of significant gains where it's going to be worth your while to change the assets of the fund, but it is certainly an area that you need to be aware of. So what we know is we lose that tax exempt status, okay? But that's only on that pension. We can regain it almost as immediately by starting a new pension. And the fact that there is little activity generally supports our ability to do that. The other thing is the recalculation of the tax-free and taxable pension. So if you have a reversionary pension in place, your pension will continue on and it will retain the tax-free and taxable that you started with if it is an automatically reverting pension. However, as I said before, any death benefit that you pay out from an interest will also be paid out in the tax-free and taxable status that it was set up for. So if you have a pension and the member passes away and then you elect as a surviving trustee to start a new pension with that benefit, it will be paid with the same tax-free and taxable status as the first pension. But what's important there is if you've got multiple pensions, that you potentially stagger the start time. So if you're doing your estate planning for the payment of that second death benefit and you have one taxable pension and one tax-free pension and they're not reversionary, what you don't want to do is stop those two pensions on the same day and start a new pension because you've just merged, like in Jack's example before. But you can stop one pension on day one, start a new one for the spouse, and then stop the second pension on day two and start another pension for the spouse as a death benefit payment and preserve the tax-free and taxable status of those pensions, because that is where the importance comes into a lot of the planning. A lot of the planning you do for years to get the tax-free and taxable right, you don't want to undo by doing the wrong transaction on one single day, and they're the areas that we can certainly help you out with. Can we alter the terms of the pension? Again, so I've said here, if the pension is not reversionary, you lose the exempt pension income deduction. Okay. So everybody that started their pension before the 1st of July 2007 that aren't reversionary, are we trapped? Well, our legal position on that is no. Our legal position is if you want to make your pension reversionary now, you can make your pension reversionary now. You can do it either via a binding death benefit nomination, or you can simply look at altering the terms of the pension. And we'll be looking at that probably over the coming months and I guess years as well for some trustees, as to just how we adopt that, because for a lot of people it will just be a matter of retaining status quo. We know what we want to do. We want to transfer to a new pension, so maybe we don't need to go through the process of changing the terms of this one and introducing a new pension just for the sake of it. So if your pensions are not automatically reversionary, don't fret, okay? Have a look at them, see what your current situation is, see what perhaps your nomination of beneficiary says. If you want to nominate your spouse and your spouse is the surviving trustee, okay, then things should generally flow through all right. But the other thing is too, you've got to look at your legal personal representative situation. And this is where the introductions of third parties as legal personal representatives can add an element of interest to the whole death benefit situation. Okay, because naturally with a lot of legal personal representatives, there's also an underlying benefit to them from a financial point of view as to how decisions are made. And too often we've seen either with our own clients or through cases that are quoted within the industry of the child that comes in and acts as trustee on the parent's death, and the other child who has no interest in taking on those trustee responsibilities, and then they start to complain when all of the superannuation money is paid to the child who became the trustee, because incorrect estate planning was done and that child has acted as trustee, acted as they believe in the best interest of all beneficiaries. Now we can clearly see that it's not in the best interest of all beneficiaries if one sibling's not receiving anything and the other's receiving it all. However, there's nothing in the law stopping them from doing that, but of course that can all be challenged. So you've got to make sure when you're talking about legal personal representatives and you're talking about who is going to act on your behalf when you pass away, that you have a clear idea as to how you want your superannuation benefits paid and you document that. So we can add a reversionary at a later point in time. We can create binding nominations if we need to. These are certain areas that we need to consider. And again, trustee discretion I think is not such a bad thing, and I highlight the case now, but it leads into our next area when we talk about not paying the minimum pension. But a reversionary pension is a continuing contract. So if you have a minimum pension and you die and you have an annual pension liability, so you don't pay it monthly and you die, and you then have that 2 to 3 months of the grieving process where no activity occurs, and that happens to coincide with the end of the financial year, and you don't pay your minimum, then you've just created a different situation, a different problem for your super fund. Whereas if you don't have a reversionary pension and you just elect to start a new pension, then that period of while the member was alive becomes irrelevant, because one thing that the law benefits us on, it says if you die you don't have to take a minimum. Okay? Kind of obvious statement. Once you're dead you don't have to pay yourself anymore. All right? But what a reversionary pension is, what an automatic reversionary pension is, it suggests that nobody ever dies, because the pension isn't just a liability to a person, it's a liability to continue paying that pension on. Okay, so there's a difference between reversionary, automatic reversionary, and just a new pension that we commence, and it can have consequences when we talk about minimums and maximums. So just to summarise that whole capital gains tax situation so people are clear of it, is if we purchase assets, we then start a pension, any activity in that period of time, so any activity in here, there's no capital gains tax liability when we sell down the assets, unless you have accumulation money, okay? We've got to identify that we're talking about funds 100% in pension, not with accumulation interest as well. If the member dies, any assets sold beyond that point in time have a capital gains tax liability, so that's something that we need to be aware of. So what are our options as surviving members? Whilst we are alive, we can reset the cost base of our assets. Okay, that's something that you'd need to talk to people about on a strategic basis. However, there are also tax options available. There are deductions available. Future liability, if a member passes away prior to age 65 and has insured benefits, there is a deduction available. Alternatively, there is something called an anti-detriment deduction, which some of you may have heard of. It's not the simplest of deductions to calculate. I certainly wouldn't recommend that everyone just go, we're going to do anti-detriment, because it doesn't work that way. You actually need to be able to pay out more money than you have, which conceptually sounds exceptionally difficult. And certainly we haven't seen it work successfully in the 13 or so years that we've been administering death benefits within the super fund. Again, when we started out, it was a lot easier to administer death benefit, because generally when you've only got a few hundred clients, you have very few people die in a year. Okay, but the larger we go, unfortunately, the more we've had to experience dealing with death benefits, and And whilst it's an uncomfortable thing to say, we've become pretty good at paying out death benefits. But what it means is we now identify all the areas that we can assist you with as far as trustees, and you have to become comfortable about talking about death. I know I've said this before. When I used to first meet with trustees, I used to talk about if you die. And conceptually that doesn't really work because all of us do die. And so I've then introduced the word when. Okay, and that's what you have to talk about when you're looking at setting up a self-managed super fund. One of the questions you have to ask is, what happens when I die? Okay, and that was a presentation last year. Maybe we'll have to repeat that one again next year for trustees as well. But these are the options. We also can look at segregating assets and using an actuary to benefit as much as we can from a tax point of view. And that's just a strategy that we can look at a later date. The last part of this ruling, which is probably the most important part, is that the ATO have come out and said that a fund that fails to satisfy the pension standards doesn't have a pension. Okay, so what they're basically saying is if you do not pay your minimum in a year, then you don't have a pension. Right, now that's a fairly big statement to make, and it has a lot of other ramifications, but effectively what it means is that if you miss the mark at the end of the year, then theoretically that pension didn't exist, and the tax office say it didn't exist for the whole year. So you make 11 payments, you miss the 12th payment, those 11 payments will be treated as a lump sum. Okay, they won't be treated as a pension, they'll be treated as a lump sum, and the fund will not be entitled to its exempt pension income for the full year. It also means the tax-free and taxable components that you had to start that pension no longer exist. They stopped at 30 June when your pension ceased because you didn't draw your minimum 12 months later. Now, there are ways for us to work through this, but that can be quite critical. If you've spent a good deal of your latter years, your pre-retirement years, if you spend a good deal of that period doing recontribution strategies, other sorts of multi-pension strategies to get your tax-free and taxable status appropriate for your estate planning situation, and then you don't pay the minimum, then all that work can be undone in 1 year. And 1 year of good gains, 1 year of good income coming to the fund can take that 100% tax-free pension and reduce the tax effectiveness of it. So meeting the minimum pension is a critical issue. And in the past, I'm sure there are people in this room who have had letters from us saying you've got a shortfall, pay it. Okay. Now we're going to change that. We're going to send you a letter before saying don't have a shortfall. Okay, because if you do have a shortfall, then you're going to create a situation for yourself. Okay, we've got some scenarios that we can look at as to how to best avoid this situation. Of course, my final dot point on the presentation will be the best way to avoid it is just to pay the minimum. That's the obvious statement, but then there are other things that we can look at to make the situation better. So what are the problems that are creating this, or that this will create? We lose our tax-exempt status for the fund, but we also change the tax-free and taxable status of the pension, as I've said, and it will be a new pension the next year. Okay, so if you have gone along, not paid your minimum, but kept drawing a pension, and the following year subsequently met the minimum pension, well, they've got the new tax-free and taxable status, and as I said, it could have a huge impact on the estate planning. Right? Not from a CGT point of view, but on the tax-free and taxable. Again, adult children pay 0% tax on the tax-free component. They pay 16.5% tax on the taxable component. Okay, that's a big difference by not meeting the minimum requirement, but also the fact that the fund is going to be paying at least 10% on the income of the fund, that the income of the fund generates that year. So these are the areas to be aware of, working through them. However, there's always a brighter note. Okay, the brighter note to missing the minimum is if the fund has lost value, then what the law says is that all negative earnings come from our taxable component. So if you've got a larger taxable component and you can forecast the market's dropping, then potentially you might want to look at not paying your pension and subsequently drop your taxable component, because then the reset will be higher. And just to show you an example of that, a very small example, but just to show you how it can differentiate, we've got Jim, who's 55, has $1 million in the pension, half and half, 50% taxable, 50% tax-free, doesn't draw down enough, okay, so only draws down $20,000, okay, required to draw the $40,000 down. So this pension doesn't exist. That $20,000 will be treated as a lump sum. If the fund for that year had increased in value by $100,000, because it's in accumulation, that growth is taxable. So Jim's new taxable percentage would be 54.5%. However, if the fund decreased in value by $100,000, so the market's dropped by that same $100,000, his taxable component would now be 44.4%. So he's increased his tax-free percentage by about 5%. Now, that's not a big number when we're looking at purely as a percentage, but over $1 million fund that then continues to grow, that can be a significant amount of tax that's being saved from a non-dependent, from a tax point of view's position. So again, there is always a silver lining. It's a fairly small silver lining overall compared to the concept of losing the tax status for most funds, because most of us don't want to see our funds continually going south. Okay? We'd all like to see the markets improve and our capital grow. I'm not sure how many people in the room here have a transition to retirement pension, but there is another issue associated with this, and we talk about minimums, and the tax office talk about minimums. If we don't pay our minimum, we don't have a pension. On the other foot, if we have a transition to retirement pension, we've got a maximum, and that maximum is 10% of our account balance or of our pension interest. Now, what the tax office have also come out and said is that if you take more than the maximum, you also don't have a pension. Seems kind of strange to say that if you take too much money out that you don't have an income stream, because clearly you've got an income stream. You've taken more money than you're entitled to. What they're saying is you don't have a pension. So what does the ruling say? The ruling says if you don't have a pension, all those amounts have to be treated as a lump sum. That becomes a bit of a quandary if you're in a transition to retirement pension, because you can't take lump sums. So the tax office have just said, we can't treat this as a pension, we're going to treat the benefits as a lump sum withdrawal. Hey, guess what? You're in transition to retirement, you can't take lump sum withdrawals. What's the worst case scenario? The worst case scenario is the tax office say, well, you've just breached the benefit payment standards. Now, what does that mean? Well, that means your fund's non-complying. So then not only do you not have your pension, you don't have your tax exempt status, you've also got a nice little 45% tax liability on top of that. Now, that's the worst case scenario. But what I wanted to introduce you today was the worst case scenario, because we'd much rather you see you take the right amount or just slightly under the maximum transition to retirement than to try and work out what to do if you go over that 10%. So if we can tell you that potentially you're going to lose half of your assets by taking slightly over the 10%, there's more likelihood that you won't take over 10%. Okay? Thankfully, we don't have that issue arising a lot. Okay? But it's one of those things to be aware of. But there are solutions. And again, we'll give you the worst case scenario, we'll also tell you how to fix it. But we'll tell you what you can do to make sure you never go over your transition to retirement limit. Where are the risks associated for yourselves as members? Well, the biggest risk at the moment is the government. I mean, that's a general statement, I think, overall, but from a pension point of view, the general risk is that we had a minimum up here. We then had a global financial crisis, and the government brought our minimums down here. They reduced our requirement to draw by 50%. Okay, so for a lot of people that maybe weren't meeting their minimums, that 50% reduction was great, because all of a sudden we were. Now we've gone back, okay? For this year, it's a 75% minimum requirement, or a 25% discount if you want to talk about the discount rate. So we only have to take 75% of what the legislation tells us to take. But what that means is if we were motoring along at 50, we now have to increase. And that 25% difference could be the difference between having a minimum being met and not being met. Similarly, next year, we go back to 100%. So once we do that, we need to make sure we increase again. If the capital of our fund remains the same, we need to make sure that we can meet that obligation. So what are our options? these are all our legislative options, okay? And some of them I certainly wouldn't be recommending. But if you don't have the cash available in the fund, so you have big, lumpy, illiquid assets, you know, the legislation has provisions for you to be able to borrow to pay a benefit. It's fairly restrictive. You've got 90 days to pay it back, and the most you can borrow is up to 10%. So you're going to cover your minimum, but it's fraught with the fact that if you've got a big, illiquid, lumpy asset, are you going to be able to pay that amount back in 90 days anyhow? So that's a risky area. Second one is the use of a cheque or a promissory note. Now, I'm going to explain what this means in a moment, because from a cheque and promissory note point of view, it gives us an opportunity to pay our pension, and it gives us an opportunity to be forgetful for a day or two. Okay? It doesn't give us an opportunity to rort any part of the legislation. It just gives us some processing time. All right? And then the other one is we can stop our pension. Right? So the minimum pension is prorated for a certain period of time for the year, which is 365 days. If we stop the pension before the 30th of June, we only have to pay however many days was in that period. So if we haven't made our final quarterly payment, maybe we can look at going back to the end of the last quarter and stop the pension at that point in time. That at least minimises the impact of losing the exempt pension income deduction. Just a strategy that can potentially use. So the use of cheques and promissory notes. Tax Office came out earlier this year and basically said that if you pay a pension, and I put cheque first because the majority of us use cheques. Most of us don't walk around with promissory notes handy for our superannuation fund. But if you have a chequebook for your super fund, and majority of you would have a chequebook for your super fund, and you write a cheque, then the tax office consider that cheque to have been paid on the day that you give it to the member. So that's an early morning process. You write the cheque, you give it to yourself, you've paid your pension. Okay? You've then got to bank that cheque. Right? And that's where the problem lies with a lot of people. They come to us in September or October, say, oh, we haven't banked our cheque yet from July. So that's convenient. You've got an issue. So what this cheque and promissory note issue really is about is the tax office are comfortable, and they have said that if you are given a cheque or a promissory note by the 30th of June, then the fund has paid the pension. So the only message I'll give to you all today is have an emergency 30 June cheque sitting in your chequebook that if you get to the 30th of June and you haven't transferred that money, then take that cheque to the bank in the next couple of days and you'll meet your liability. Okay? The tax office said that, but I'm saying the next couple of days. You might hear others talking about months and things like that. I would never want to be taking that risk. All right? That if you don't take that pension, and if you don't satisfy the liability within the first week or so of July, which what the ATO would consider is usual standard business practice, that you bank a cheque within a few business days, right, then you are running the risk of not having a pension. Okay? Clearly, electronic transfers set up midway through every month or every quarter is the best way to pay a pension, but we understand that some people like to write cheques. Okay? If you're going to write cheques, don't wait until the end of June, pay them a little bit earlier. Okay? That is a way to utilise it, but you've got to have the liquidity. Again, you can't have a cheque, you can't write a cheque or write a promissory note if you actually don't have money. Okay? Because it is just a piece of paper, and it's just a piece of paper until the bank say it's worth something else. All right? So you can't use this strategy if you don't have the money in the super fund. You can also transfer assets, okay? Now, I said before you can't pay a pension in the form of an asset, okay? You can pay a lump sum, all right? So you can transfer an asset, you can complete an off-market transfer on the 30th of June. So that's one of the ways that you can meet the liability. I'm conscious of time. All this information, obviously, you've got in the presentation there. Again, this is not a strategy necessarily that you'd be wanting to use, transferring assets at the 30th of June. And the other one is that you can commute the pension, stop it, as I said, go back to the end of the previous quarter and start a pension up at that point in time. Okay, similarly with transition to retirements, the maximum is not prorated. So if you've gone over your 10%, there's nothing stopping you from stopping that existing pension and starting a new one and therefore recalculating the 10%. And potentially that will then bring you under your limit. But again, the numbers are going to tell the story and the timing, so they're the things that we'd need to be careful of. So the issue that the tax office have still got a lot of unanswered questions, okay? Technically, like, what happens when a person dies? And one of the things that I didn't go through there was this issue of, you know, if you do have a periodical payment in place and you die and no activity happens, those periodical payments still happen. Tax office are now saying they're lump sums. But clearly we all know that they're just a continuation of the previous pension contract. So we want to see how the ATO are going to treat those sorts of payments. There's a lot of things to consider there. Death, there's no difference. We just want people to be aware of the tax scenario for them. Reversionary pensions offer a peace of mind, but they can also offer problems if you don't meet the pension liability. So you do have an issue. And there can be tax ramifications for the super fund by not meeting the pension. So the best strategy is to pay the pension every time. So that's the pension issue there. I'll give you very quickly a 2-minute update on the industry, so we can then finish off and have some questions either in here or outside. Anyone that's interested in borrowing, Tax Office have released a ruling on limited recourse borrowings for self-managed super funds. And previously we talked about the fact that you couldn't improve an asset that you borrowed money to acquire. Well, the Tax Office have clarified that, and you can improve an asset that you acquire, so you can improve property. However, you can't use borrowed monies to improve that property. So you can use existing money of the fund, you can make additional contributions to the fund, you just can't borrow to improve that asset. What you also can't do is you can't change the nature of that asset by those improvements. So you can't improve your residential property and turn it into a business property. Okay, that would breach the legislation, but it does give a little bit more flexibility. And the other side of things which created issues from a limited recourse borrowing point of view was this concept of a single asset. A single asset is defined, or was previously defined, as one title. So in a property point of view, if you had an asset split over 2 titles, you would have to do 2 borrowing arrangements, which was somewhat inconvenient and inappropriate and unworkable with the banks. The Tax Office have come out and now said, if an asset can only be defined as an asset, so you've got multiple titles, but you have a great big factory that splits those 2 titles or goes over those 2 titles, clearly that can only be bought and sold as a single asset, and so that will satisfy the definition. So there are some rules there, so anyone that's interested in the limited recourse borrowing issues, by all means, come and ask some questions. The other issue that happened, the other change that we've seen, is a change to the collectibles and personal use assets. Any of you that have any of these assets in your fund, artwork, jewellery, etc., etc., if you had them in your fund prior to the 30th of June, then you've got 5 years to take action on these assets, okay? Because a lot of people hold these assets and they store these assets in their home or in their place of business. Well, you need to make sure that if you've got these sorts of assets that you go by the new rules. Basically now you can no longer acquire these assets and use them for personal benefits or lease them to a related party. Okay, there are going to be some real tight guidelines for anything that you acquire which is considered a collectible and personal use asset. So you've got the list of what the ATO defined there, but what the rules, it's interesting, I put that last point on there in case we needed to know what spirits were. They have legislated what a spirit is, which is terrific, but all those beer connoisseurs out there, that's not on the list, so beer is still clearly a legitimate investment strategy for a self-managed super fund. So what can't happen with the assets? It can't be used by a related party. Okay, now this is a thing where you used to have the incidental use. You used to be able to use an asset incidentally, i.e. you could have a car, a vintage car, you could drive that car to the car show because that car show is going to improve the value of the asset. Now you can't. That is personal use. If you get behind the wheel of that car, that creates a personal use situation. So you need to get someone else to drive that asset to the show. Can't be leased to a related party. Okay, you can't lease any of these assets. So paintings that we used to lease to our business premises, we can no longer do that. If you want to lease artwork, it has to be leased to a third party. Okay, so that creates issues because then you have to have it insured in the name of the super fund, not necessarily the property where it's being stored. So where this all comes from is the government wanted to introduce a ban on these sorts of assets. The review into super wanted to introduce a ban. The government said we don't support a ban, we're going to introduce regulations. Well, as you can clearly see, these regulations support a ban on collectibles and personal use assets because they make it very difficult for you to hold these assets. You can't store an asset at the private residence of a related party. Okay? So what that means for all of you that have a piece of art in your superannuation fund and you're currently storing it under storage, or as we like to say in the living room, you can no longer have that on the premises. All right? You can store it on your business premises, but it must be stored, not displayed. Okay? It can only be stored on the non-private residence, so if you have a storage facility. So it does make it very difficult. You have to insure the asset in the name of the fund within 7 days. You must document why you're storing it in a certain place, and you must retain that documentation for 10 years. And if you're going to sell it to yourself, okay, it must be valued by a qualified independent valuer, right, prior to the sale. So if you currently have these assets, these are all the things you must adhere to by the 30th of June 2016. Right? And if you try to buy any of these assets now, you have to stick to these rules from this point in time on. So it does make it very difficult. So look, thanks very much for coming along today. If anyone's got any questions before we remove ourselves to the other room, then by all means ask away. Otherwise, myself or the blue labelled Cavendish employees will be out in the hallway to answer questions. But other than that, thanks very much for coming along today.